Nick Asen. I had a client last year, a business that I guess we did invest our time and energy in them significantly over 8 or 9 months. We did take them on a road trip. We did put them in front of quite a few investors, different investor groups and types. We spent a lot of time on market development, so opening up sales opportunities. It was in the sensory wearable tech space. So we took them into, F1 opportunities, soccer opportunities, and. And the team had a reasonably demonstrable product, a good demo actually, and we managed to, through a series of placements, get them a little over $1 million. And that was to be used to continue the push with marketing, continue the push to get new business and get ready for a bigger round, which we were working on. Now, the problem with this company was a few things. They had 2 term sheets offered to them, and on the first term sheet, which I think was, from memory, set the valuation at about 40 or 50 million, which is quite decent because they hadn't really got much revenue activity going, but the potential was huge and they had a good pipeline. But they didn't stick to their numbers, and the investors lost confidence because they weren't converting the pipeline, and the investor withdrew. The second term sheet was equally interesting. It was for 15 million, and the investor was quite happy to accept a 60 million valuation, which I thought was a bit heavy, a bit toppy. And then the founder started saying to me, well, we don't really want to give up board seats. We don't really want these investors involved. We want their money and we want them to leave us alone to get on with it. Well, I'm sorry, it doesn't work that way in terms of risk and return for investors. You have to give something up. You have to put skin in the game. You have to offer some protection. I mean, liquidated clauses, special rights and what have you is all well and good, but that's on the assumption that they pick the value out of what's left of the assets if you don't deliver. So at the end of the day, you really do have to think about, the investor's point of view. And this was actually a family office, a private investment, and the first one was actually a fund. So yeah, if you're a founder and you get a term sheet and you get offered it, be sensible. Think of it from the investor's point of view. Don't grab the money and say, well, unless I get this and I have absolute control and all of this, then I'm not going to do it. Because it may well be that the investor will set some milestones and expect you to achieve those milestones to draw that capital down. And in a sense, that's fair enough, isn't it? Talk soon.